Hello and welcome. My name is Grant Collins. I'm an independent economist with AIM Research. And in today's video, I want to talk a little bit about the employment data that came out last week, the Fed's interest rate decision and monetary policy going forward for the rest of this year, and really just kind of unpack all of the jam-packed data that came through last week. I also want to spend a little bit of time and cover what data is going to be coming out this week and what you should be thinking about moving into the May month and moving into the inflation week here. So with that, let's get started. So I want to start by sharing my screen. And I primarily want to focus on the Federal Reserve first. So it was really interesting. The Fed went ahead and Jerome Powell went ahead and raised interest rates 0.25%. By doing so, that new range is between 5 and 5.25. So this first chart that you're seeing here, the red line is the lower level of the Fed funds range. The black line is the upper level of that Fed funds range. And the green line is the actual effective federal funds range. I also have two market indicators, the 1-month Treasury, which is in blue. You can see that the 1 month tends to trade within that band extremely well. The 1 month tends to move with the federal funds range. And the 2-year in yellow here tends to lead the Fed here. So the market will tend to rise before the Fed does, just as it did in 2022, and it'll fall before the Fed does, just as it's doing now. In fact, as you and I talk here, what's really interesting about this data today is the gyration in the 1 month. So in blue here, you're seeing the 1 month, and you saw a sharp draft downward as the 1 month was trading at about 3.8%. That's where there was a lot of talk about the money market debacle and the fact that everybody was moving money out of banks and into the money market here. And now we've seen that rate shoot straight back up. And in fact, as I'm looking at it here this morning, today being the 8th of May, I'm recording this a little bit late. It's at 559 as of Friday. So this is really dramatically come back and even overshoot the chart that I'm showing you here. But it illustrates that gyration in the 1 month because, again, the 1 month typically trades within this range. So this 1 month, if it's under any indication, maybe it's going to potentially forecast an increase in rates in June. That's not my base case. I think even coming into the meeting last week, I was expecting them to hold interest rates at 5% because it does two things, right? It gives credibility to the banking crisis, but at the same time, it still remains restrictive so that way inflation can continue to come down here. That's not what happened, so we'll have to see what this is going to look like going forward from here. Now, outside of raising the federal funds rate, they did go ahead and reaffirm that they're going to continue to reduce the balance sheet. They're reducing it to a tune of $95 billion a month. So I want to spend a little bit of time here and talk about the Fed balance sheet composition as well as what they believe is the ample reserve regime. So the Federal Reserve balance sheet is comprised of treasuries and mortgage-backed securities. You can see in black. It looks like the reserve balances are just a touch over $8.5 trillion. You can look at the treasuries and the mortgage backs here. The treasuries have been coming down much, much faster than the mortgage-backed securities, and I think that's important for us to note and contextualize here. That, again, is just balance sheet runoff. Here's what I want to talk about of ample reserves. So these reserves that are in the system in earlier monetary policy changes, they decided to change and make sure that monetary policy always operates in a ample status, meaning that reserves are plentiful and abundant, that they're not scarce. That's important because currently monetary policymakers believe that helps them set interest rates better. It helps the 1 month Treasury and the short-term funding rates not gyrate above or below their upper or lower bands, and they believe it leads to smoother functioning financial markets. That's important because the way that I'm thinking about it and framing it is say, hey, look, if they want to operate in an ample reserve regime, what that means is there's a floor to balance sheet reduction. So much so that Jerome Powell actually told us in 2019, they found out that they went through the floor. And so Jerome Powell specifically stated it in a paper that comes from the Board of Governors. You can find it. It's the Fed's ample reserve approach to implementing monetary policy. In that paper, Powell is cited as saying, look, maybe the floor should go no lower than 1.5 trillion. You can kind of see that here in this bright yellow at 1.5 trillion. You can see how the balance sheet reduction of reserves actually went through that floor. I think that there is a better floor. I think currency in circulation is a good floor. That's currently setting at $2.3 trillion, 2.324. And you can definitely see how if they continue to run the balance sheet off at $95 billion a month, it's not going to take them long. If reserves are sitting at just a touch over 3 trillion, you can get there in maybe 8 months or so. So at the end of this year, if they keep doing balance sheet reduction, you're going to get into maybe even more of a liquidity or maybe a credit crunch because of that as well. I've also got one more estimate on here. Fed Governor Waller and some others have estimated what the potential floor is for ample reserves. And this GDP estimate is 8% of GDP. And you can see that there. It does track really well with currency and circulation. I don't think Jerome Powell's static $1.5 trillion is going to be good enough. I do think that there does need to be some upward momentum to reflect the fact that reserves are going to be increasing or decreasing. There are things that affect reserves that the Fed has to be looking at. Those two things are down here. It's the TGA account and it's the reverse repurchase agreements, as well as currency and circulation that you're seeing up there. So they do have to factor all of those in balance sheet reduction before they hit one of these floors. Now, which one's right, I don't think anybody knows. I don't think we'll know until there's more research done. This is just kind of my general interpretation. So again, this balance sheet reduction may have, give or take, 8 months or so before you hit the top level, which is currency and circulation, maybe a little bit longer for real GDP estimates, and then maybe a little bit longer for the implied floor from Powell here. My biggest takeaway from the Fed meeting here is that it does seem to me that they are going to pause. Again, I thought that coming into this meeting, I thought that, there's plenty of evidence to show that they are restrictive, be it credit spreads widening, be it bank failures, lending standards tightening. You can find a reason to say that they were restrictive. So there was enough evidence there to me that they should be pausing, even though that's not what they did. He did go ahead and raise interest rates because the employment data came out better, the inflation data came out better. We're going to look at employment here in just a second as well. But by looking at all of those, on balance, that was his ultimate decision, was to go ahead and raise interest rates. I do want to point out, though, that he didn't remove further increases off the table. He did, however, say that cuts are likely off the table. And that was so important because you do have to make sure you keep pressure on that inflation problem, right? I do think there's a case to be made that inflation can be sticky. I still think it's coming down, and you're probably going to continue to see some more maybe positive movement down, as we've seen from the PPI reports, as we've seen from the Fed survey data, right? So the point here, though, is that they keep the pressure applied and just know that they don't need to apply any more pressure. And I think that could be a case for a potential policy mistake if they go too far. But at least right now, I think on balance, Jerome Powell is keeping a good even kill. That's enough on the Fed. The Fed already lives in the limelight enough. We don't need to spend our whole weekly review on just the Fed. Again, last note before I move on, I think that was the last rate hike, and I think they should be almost done here at this point with raising interest rates. Now, what other data came out this week that I think is important for us to know? So I don't have data on it, but the ISM, both manufacturing and non-manufacturing PMI data came out. Both of them slightly accelerating, so that was somewhat of a positive sign for the economy, as both of them have been trending lower. The ISM manufacturing still very much in contractionary territory at 47.10 compared to the 46.3. The ISM non-manufacturing, or the service side of the economy, accelerated, still above in growth territory, going from 5.1 51.2 to 51.9. And so both of those painted a completely different story. We have been hearing that the service economy continues to drive good growth and continues to drive and show good consumption from the consumer side. However, the manufacturing side continues to remain troubled. And maybe we're going to see some of that reflecting in the employment data. So stick with me as we go through that. What other things that you need to know? Total vehicle sales accelerated from 14.8 million to 15.91 million. And then finally, mortgage applications dropped again. They were prior month was 3.7. Prior week was 3.7, and this week was minus 1.2. That gets us to the employment data. And I want to start by looking at the JOLTS job openings labor turnover data. So the JOLTS data was very, very interesting. We saw some good positive signs out of the labor market, particularly for two things. One, we saw some continued weakening and continued cooling, but also showing signs that things aren't getting worse, if that makes some sense here. Maybe I can show you some data to outline this a little bit better. So job openings continued to come down. I might grab a highlighter here so that way we can see it. So job openings continued to come down to now 9,590. Actually, this is in millions. So, this job openings number is important primarily because of the way that Jerome Powell looks at it. Jerome Powell looks at this as job openings relative to the total unemployed worker. And so I'm going to show you that in just a second. It's right here. So that's currently 1.6. So you can definitely see that it is still elevated, that there's almost 2 jobs for every person looking right now. That's important because of how well it tracks with wages. So you can see how there's a very good fit to this data, or very good positive correlation between wages and this ratio of job openings to unemployment workers. And that should intuitively make sense. So think about it. If there's a lot of job openings, but very few workers looking for jobs, well, what that can mean is that the workers have more negotiating power. They have the ability to come in. They have the ability to say, well, this guy down the street's going to pay me 20. What are you going to pay me an hour, right? And so that's why it tracks so well with wages and why he's looking at it so much here. Wages being a key input into potentially the inflation problem, which is going to come out next week. Now, what else came into the job openings data? It was the quits rate. The quits rate continued to come down as well. That's also, again, another positive sign that the labor market is cooling off a little bit. Hires didn't change much. You can see that it kind of moved sideways here. Layoffs did come up a little bit. You're seeing that there. You also maybe see some of that momentum showing up in initial jobless claims. Excuse me. But for the most part, very much starting to see some change and some momentum there of layoffs. Other separations, this typically just includes retirement. Retirement has been coming down, and it typically comes down as you enter really troubling times. So like 2008, retirement really slowed down. It's really slowing down right here too, and it could be just the uncertainty of the environment. Let me show you a couple more things before we move into the broad employment report. So the labor supply and demand. So there's 2 ways to look at this. You can look at non-farm payrolls, and you can look at the employment level. If you look at the non-farm payrolls plus job openings as an indicator for demand versus the labor force participation rate as supply, you can see a very tight labor market here, that they're very much well in balance. If you like to look at a different measure, if you like to look at the employment level plus openings compared to the labor force, you see a much different picture. There's much more demand than there is supply. And so you can pick your data as far as which one, but either way, I think paints a picture of a very tight labor market, one that is still remaining somewhat competitive in the fact that there's, almost 2 jobs available for everybody working right now, and why we've not seen mass layoffs. I'm kind of in the same camp that Jerome Powell is. We need to see that labor demand cool a little bit more to make sure that, the processes and the tightening that we've seen so far is in effect. I would also venture, before we get into the employment data, that we're starting to see a little bit more of it. And I think you're going to get a pretty good view of that in just a second. Here's the first indicator that I would point out that shows that. It's the Kansas City Fed Employment Index. So again, this combines 24 labor market indicators together to make a composite index. This composite, again, produced by the Kansas City Fed, you can see that that's been weakening now really since the spring of 2022. And you can see that versus the trend, right, that it's been deteriorating for some time as well. So again, the gold line there is the trend rate of the index. The blue line is the index itself. The red histograms or bar charts here, that's the difference between the index and the trend rate. And that's why I'm showing you kind of moving into this negative territory or losing momentum, so to speak. And this is why I think that we have to pay attention very closely to the labor market data going forward from here. Now, that gets us into the jobs report that came out on Friday. And I think on balance, it did extremely well. What jumped out at me the most, particularly, was the sides of the economy that you think are doing well, are doing a little bit better. But then there's also some surprise factors in here as well. There's a couple of sectors of the economy that there is still a lot of hiring going on, and I want to highlight that with you today. I also think that you need to pay attention to the average hourly earnings. Excuse me, again, that goes back to the wages that we just looked at. The fact that average hourly earnings ticked higher, the fact that we've seen personal incomes accelerating in the last report continue to suggest that the consumer is not losing their job. The consumer still has enough income. And this, on balance, tells me that there's more legs to this cycle, even though the cycle is slowing down. So let's move into some of the labor market data. So here's the total non-farm payrolls. The difference here was 253,000 jobs. When you look at it here, I think you can see it really well. You see this kind of topping pattern. I would argue here that this looks very similar to the Kansas City Fed Composite Index. I'm going to toggle back and forth for just a quick second here. Even though you haven't seen this go negative yet, which I think you need for it to be a kind of recessionary period like you're seeing here, 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 and here, we're not there yet, right? The unemployment rate even suggesting that as well at 3.4%. It's well below the natural rate, which is in yellow here or gold here, setting at roughly 4.4%. And then there's the trend rate of unemployment that hasn't really started to trend higher yet either, like it's done here, here before the recession actually starts. I'd love to see that trend starting to turn, but it just hasn't done it yet. And I think that's important to note. Here's that labor force participation rate at 62.6. It has yet to come back to pre-COVID levels, whether you're looking at the labor force participation rate, goodness, getting tongue-tied here, or the employment to population rate. Neither one of them are back to COVID type levels. That also, I think, is a good reason why you might see this gap in labor market and why you're seeing such a tight labor market here. Now, I told you we were going to hit on average hourly earnings, and I think it's important for us to note that continuing, it looks like on a level perspective, to accelerate here. When you compare it to a trend, though, it is kind of toppish here, right? It does look like it's coming down. And so maybe, just maybe, the income side is going to kind of hold here after declining a lot throughout 2021 and 2022. Here's that resurgence there that I was talking about. And so to see that average hourly earnings increased 0.5% when everybody forecasted 0.3% is that surprise factor, right? This is where everybody says the jobs report was really well or really good, so to speak. Coming down, though, I want to maybe make a paycheck proxy out of this to maybe give you a different way to look at it. Since we have average earnings and we also have the average work week at 34.4 hours, we can definitely see that the work week has gone down even though the average earnings have stayed stable. So on balance, you would think that families and households are making a little less. Well, here's that paycheck proxy for a whole calendar year. Maybe that's an average of about $57,000. And you can see that it's below trend, right? That, again, it looks toppish and looks like it's decelerating a little bit here. That's a strong difference than what we looked at in the personal income data. The personal income data showed that dividends and interest payments were a key component in why the incomes accelerated. Dividends and interest payments are not in this paycheck proxy. It's just two inputs. its average work week and its average hourly earnings. That's it. Just the combining of the two. So just another indicator for us to look at for the health of the consumer here. Now, while we're still on the jobs topic, where were the big changes or the big shifts in the industry? So let's just go through it from top to bottom here. Mining and lodging is up first. You're seeing 642,000 jobs available here. That's still accelerating. There's no layoffs or slowdown in hiring happening here. There was only a difference of 7,000 jobs hired there from the prior month, but I definitely thought that was interesting to see this one still elevated and still doing extremely well. Construction is one I think everybody looks at. There's roughly 8 million jobs available in this space. 8 million jobs total. We've already looked at the JOLTS report. We're now on to the new one. The 7.9 million jobs in the construction industry, that's a difference of 15,000 jobs from prior, but it's still a positive 15. So there was still a net addition here. Definitely looks kind of toppish to me. Definitely looks like a peaking pattern happening as far as construction. We're not seeing mass layoffs of construction yet, but definitely looking a little toppish there. Here's manufacturing. There are quite a few jobs available here in this industry as well. It's a very big industry. You can see that it is above trend, but you can see that the momentum or the deterioration is there as well. Again, not through zero. Again, there was about 11,000 jobs added this month versus last month here. So I think that's a key indication as well. Let's keep coming down here. Professional and business services versus the trend. So again, another really large category as well. Businesses and professional services, think your accountants, think your attorneys, think of that industry there. Again, accelerating on a level perspective, but then when you look at it from a cycle, you can definitely see it slowing down from this perspective. This one does not include financials, right? There's a separate one that looks at real estate, that looks at banking, looks at stockbrokers individually, and that's at the bottom. So just give me a second. We'll look at banking because we know the banking crisis is in there, right? So we should potentially see some of that happening as well. Here's leisure and hospitality. Let me note one more thing here. There was an increase of 43,000 jobs in this professional and business services. That is a big difference than what we saw in the ADP report, which saw a drop of about 16,000 jobs. So those two reports didn't square well together. Here's the leisure and hospitality, a big increase as well, 43,000 jobs. It is a big driver, and it looks on the level perspective that it's still accelerating. This looks almost toppish as well, very similar to like the construction that we looked at earlier. Not all are out, deteriorating, and not all out just falling off of a cliff like we saw during COVID, but definitely looking a little toppish here. Just a few more here. I know I'm getting long-winded, but we're still moving through the service side of the economy. The mining, the construction, and the manufacturing are the good side of the economy, and you can see on balance that that's slowing down a lot more than the service side that you've looked at so far here. But again, mining seems to be the only one so far that's accelerating. Here's trade, transportation, and utilities. Again, on a level perspective, doesn't look too bad, but when you break it into a cycle, it definitely looks like it's slowing down as well. Still positive, net 17,000 jobs added in that space. Here's private education and health services. This doesn't look like it's slowing down either, and especially when you look at it on a cycle perspective, no slowdown in education and health services. In fact, there was an increase of 77,000 jobs in that area here. Here's the information. So basically the tech space, you can see a general break below trend, a slowdown, and a measly one job added in that category, or 1,000 jobs added in that category, I guess. Here's all employees, government versus the trend. So government employees looks to still be above trend, and it looks very similar to mining, private education, and health services. So those three areas seem to be the strongest in this report so far. The last one that we're going to look at is the financial activities. And again, you can see quite a bit of hiring being done in this space as well. But again, as you would imagine, with the bank failures that have happened, there's been a slowdown in financial hiring. Again, net 23,000 hires in this category here as well. So to me, it was a labor market report that I would say is good. I wouldn't say that it's strong because, again, when you look past the levels and you move into the cycle components, they are weakening and showing some signs of deterioration, very similar to what you're seeing in the Kansas City Fed labor market indicator. It continues to me to suggest a labor market that is extremely tight, a labor market that is just losing momentum as companies now move into the cost-cutting phase. One of the things that on balance can keep us from losing this labor is if productivity improves. But we did get the productivity report and it continued to come down. Non-farm productivity quarter over quarter declined 2.7% compared to the prior quarter of an increase of 1.7%. So the fact that productivity is still very low tells me that we're in this labor hoarding phase. And so to me, if the worker is not as productive, your output is not going to accelerate. If your output doesn't accelerate, your profit will probably get hurt if the demand isn't met. And so the reason to hold on to these workers may not make a ton of sense. But on balance here, there's some good service side of the economy from the government, from healthcare and education that show some pretty strong employment trends, and from mining and other operations there, where everyone else seems to either be topping out or slowing down here. I think that's a great place to stop. I've rambled a lot. There was a lot of data that came out that I didn't cover, like we didn't go through initial jobless claims, but it did come back up. It went from 230 to 242,000. We didn't cover things like the S&P Global Composite. We didn't cover the mortgage applications in great detail, but I do think overall, the data that came out this week does give credibility to the fact that they raised interest rates 0.25%. Now, what's going to give them even more credibility to raising those interest rates is if the inflation rate comes in sticky. That's what's coming out this week is the CPI report, both core and headline. Headline is projected to basically be the same. It was 5% last month. They're expecting it to be 5% again this month, where core is projected to just slow down a little bit. Core was 5.6% last month. They're expecting it to be 5.5% this month. That, I think, is going to be really important for us to watch, especially if we start to look at core services and seeing if that still accelerates, and rent. I think I've talked to this to some of you before in some of my daily notes over on our website. But on the daily notes side, we have talked about how other forms of rent measures like the Zillow rent measure have been coming down, which should potentially foreshadow maybe the actual rent index inside of the CPI or inside of the PCE to come down as well. So to me, I expect more progress on the inflation front to come down. And as I expect that progress to kind of play out and play through here, it's going to make it more likely the Fed should be pausing here. Hopefully we can remove that policy uncertainty off the table. If you remove that policy uncertainty, then as a business owner, as a CEO, as a family trying to decide if you should buy a house or buy a car, you can at least make that decision knowing that the interest rate picture is not going to change for a while. That can help you decide to get off the fence and do that economic activity or not. And that's kind of just the way that I'm looking at it here. Lots of good information. What does that mean for the market? I think on balance, it's a report for both bulls and bears. This is why I continue to think that it's just going to be a sideways consolidation year, that you've got some information in there that says, look, the labor market's cooling, maybe cooling at a pretty quick rate when you look at the Kansas City Fed or you look at the job openings coming down. And so that's a really good story for the bears. For the bulls, you've got the average hourly earnings report going up, and you've got the fact that in most of the sectors that we just went through, there was an addition of jobs, and not all of them are all out negative relative to their trend. Some of them are just kind of like topping out. And then you've even got the educational, health, and services, as well as the government, as well as mining, that were accelerating in their job growth. So lots of data in there, but to me, it just seems on balance that not too hot, not too cold. I think that's the best way to describe it. So with that, I really greatly appreciate you taking the time out of your day to get a quick update here. If you have any questions, don't hesitate to leave me a comment below or shoot me an email. I'll be happy to answer those for you. We'll be back next week to cover some inflation data and try to give you an update on what we're seeing moving forward for the rest of the month of May. I hope everyone stays well, stays safe, and we'll be back again next week with another update.